Ladies and gentlemen, good day and welcome to the Minda Limited Q3 and 9 months FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. Now I hand the conference over to Mr. Sunil Bohra, Group Chief Financial Officer. Thank you, and over to you, sir.
Thanks, Zico. Good evening, everyone, and a warm welcome to all the participants. On the earnings call today, I am joined by my colleague Ankur Modi. We have uploaded our financial results and investor presentation for Q3 on the stock exchanges and our company's website. We hope everybody had an opportunity to go through the same. I would like to begin by giving some insights on the economy, followed by the current scenario in the auto industry and our financial and operational performance for Q3 and 9 months FY24. Post that, we will open the floor for Q&A. Against the backdrop of a global economic uncertainty, the Indian economy remains resilient. A significant catalyst for India's growth has been its strategic focus on developing niche and complex manufacturing sectors. Notably, in January of 24, India's manufacturing index surged to 56.9 from 54.9 in December 23, marking the strongest growth in the factory sector in 4 months. Moreover, the growth of India's GDP has exceeded expectations, driven by robust consumption demand, increased public investment, and a strong government emphasis on infrastructure development. Government policies, including the PLI scheme, aimed at employment generation, a concerted push for the accelerated adoption of green mobility, shifting customer needs towards premiumization, and a strong emphasis on infrastructure development have played pivotal roles in propelling volume growth in the sector. Speaking of the auto industry performance for this quarter, domestically, the volumes grew by 16% on a year-on-year basis in Q3 FY24, driven by positive demand across all categories, while volumes were marginally down quarter-on-quarter basis. This is somewhat expected, as Q3 typically sees a dip in production and sales due to the festive season and due to annual maintenance shutdowns and consumers delaying purchases until the new calendar year. In the PV segment, SUV saw a strong demand. Production volumes for passenger vehicle for quarter 3 FY24 stood at 11.41 lakhs, reflecting a year-on-year growth of 5%. Notably, a significant milestone was achieved during the quarter, with passenger vehicle segment registering its highest ever sales in November, reaching 3.34 lakh units. This surge in demand was driven by festive season demand, year-end promotions, and a new product launches. The two-wheeler segment staged a noteworthy rebound in the last quarter, driven by festive demand. This growth momentum persisted in the quarter ending December 23, with production volumes for Q3 reaching 54.8 lakh units, reflecting a robust year-on-year growth of approximately 19%. The surge in demand was attributed to various factors, including festive demand, heightened rural sentiments, the wedding season, increased marketing efforts, second market share expansion, wherein Minda successfully captured a larger market share across various, increased marketing efforts by OEMs and anticipation of price hikes in January 24. Continued with the growth momentum, the two-wheeler volumes in last 2 months, i.e. December and January, have shown significant growth of over 20%. On the CV front, the production volume for the quarter ended December 23 stood at 2.5 lakh units as compared to 2.37 lakh units in the same quarter last year. This demand is primarily fueled by heightened industrial activity and ongoing infrastructure development initiatives. With healthy order bookings and a positive market sentiment prevailing, the growth trajectory for this segment remains strong. With increasing reliance on the renewable and clean mobility, the shift to EV is catching pace. For the third quarter of this fiscal year, total EV registrations stood at 4 lakhs when compared with 3.7 lakhs in Q2 of this fiscal year. Despite the sharp slashing of FAME-II subsidy in June, electric two-wheeler sales have rallied back to 2.43 lakhs in Q3 FY24, registering 34% growth quarter-on-quarter, at the same time achieving highest quarterly sales. While government slashed subsidies under FAME-II scheme, it also significantly increased the allocation for the PLI scheme. The PLI scheme received a major boost with its budget allocation jumping from 438 crore in FY23 to a whopping 3,500 crore in FY25. This indicates a strong focus on domestic EV manufacturing. The government has kindly extended the PLI scheme period since industry was not able to utilize the PLI funds in FY23 due to various operational reasons. Now, it will be applicable from FY24 to FY28, offering a longer window for manufacturers to benefit. In a separate move aimed at boosting domestic production and protecting local manufacturers from dumping of cheaper products, the government extended anti-dumping duty on alloy wheel imports from China to protect domestic industry. Coming to financial and operational performance, you can refer to slides 7 and 8 of the presentation. At consolidated level, revenue from operation for the quarter ending December 23 increased by 21% year-on-year to 3,523 crores from 2,915 crores in Q3 of FY23. This is attributed to the company's strategic focus on multiple areas. I'll try and list out some of these key areas. First, expansion of capacities and capabilities, wherein the company has been actively investing in expanding its production capacities and technological capabilities to cater to growing demand for its products. Second, market share expansion, wherein Uno Minda has successfully captured a larger market share across various segments, solidifying its position as a leading automotive component supplier. Third, enhanced kit value and complete system solutions, wherein the company has been able to offer more comprehensive solutions to its customers, leading to an increase in average value per unit sold. Fourth, focus on exports to support the vision of stronger vertical growth in existing businesses. As you would note, the growth was evident across all product lines, with particularly strong performances from EV products, lighting, switch, sensor, controllers, and alloy wheel business. EBITDA for the quarter reached 380 crores, reflecting a 12% year-on-year improvement from 338 crores. EBITDA margin for the quarter stood at 10.8%. We are on track to deliver on our stated guidance of full-year EBITDA margins at around 11%. Finance costs have increased to 29 crore in comparison to corresponding quarter last year on account of incremental borrowings for capex and working capital. The share of profit loss of associate joint ventures for Q3 jumped to 44 crores against 25 crores in Q3 of last year, as some of our JVs like Denso 10, Roki, CG, etc. witnessed strong growth. The profit after tax, which is Uno Minda's share for the quarter, was at 193 crores as against 162 crores in Q3, registering a growth of 19.4%. Moving to financials for 9 months, we have achieved consolidated revenues of 10,237 crores for the 9 months ending December, registering a growth of 23% on year-on-year basis. The EBITDA for the period grew by 20% at rupees 1,111 crores, registering EBITDA margins of 10.9%. The profit after tax, which is Uno Minda's share for the period, was at 591 crore as against 471 crore in corresponding period last year, reporting a growth of 26%. Moving to the business segment-wise performance, starting with switches, you can refer to slide number 12. Our switching system segment performed exceptionally, generating 928 crores in revenue for Q3, representing a significant 26% of our consolidated revenues. This growth can be attributed to key factors. Firstly, smarter switches and increased penetration, wherein we witnessed a rise in kit value driven by adoption of smarter switches and increased number of switches per vehicle. Secondly, strategic expansion and market capture, having successfully expanded our reach by securing business from previously less served customers. further solidifying our market position. Additionally, exports in the two-wheeler switch segment emerged as major growth driver, signifying our global competitiveness. Looking ahead, we are excited about the recent commissioning lines of our four-wheeler switch plant in Chennai, which is ramping up production steadily. Lighting. Moving to the lighting business, which continues to be a beacon of growth for Uno Minda, generating impressive revenues of 852 crores in Q3, representing a significant 24% contribution to our consolidated revenues. This success is driven by our relentless pursuit of innovative lighting solutions that empower OEMs to differentiate their offerings in the marketplace. Following strategic order wins secured over past 2 years, we are witnessing the gradual commencement of production, which is significantly propelling the growth trajectory of the lighting businesses, particularly in the four-wheeler segment. We anticipate this positive momentum to continue, fueled by increase in kit value and continuous expansion of our market share. Moving to casting business, it delivered robust revenues of 686 crores in Q3, accounting for a substantial 20% of our consolidated revenues. This year-on-year growth is primarily driven by the two-wheeler alloy wheel segment, which successfully commissioned all lines related to 2 million capacity expansion. This expansion brings the total installed capacity for two-wheeler alloy wheels to an impressive 5.4 to 6 million wheels per year, depending on the weight of the wheel. The casting revenues have declined quarter-on-quarter, driven by PV industry volume drop as well as reduction in the aluminum prices. While the planned 60K capacity expansion for four-wheeler alloy wheel at Bawal, Haryana is facing delay due to land acquisition, we have proactively accommodated an additional 30K capacity within the existing available land. This new capacity is expected to be operational in H2 FY25. We are actively pursuing the necessary approvals from authorities for the remaining expansion. Moving to the seating business, you can refer to slide 13. Our seating business, a key contributor to our overall performance, generated 274 crores in revenue for Q3 FY24, representing 8% of our consolidated revenues. This segment has witnessed consistent growth through strategic customer acquisitions in both two-wheeler and off-road segments. Exports have also played a crucial role in driving this growth trajectory. In the last few quarters, we won orders from at least 3 new age EV two-wheeler OEMs and 1 incumbent two-wheeler OEM. We have become global supplier of American commercial vehicle and heavy equipment manufacturer. Looking ahead, we anticipate the seating business to maintain a healthy growth momentum, fueled by new order confirmations and the upcoming execution of new orders. This provides a significant opportunity for further expansion and market penetration. Moving to acoustic business, it generated 202 crores of revenue in Q3, representing a stable 6% contribution to our consolidated revenues. While the Indian business continues to demonstrate encouraging growth, the European subsidiary Clarton Horn continues to experience volume headwinds compared to the pre-pandemic levels, impacting overall margins. Moving to other product businesses, which have achieved revenues of rupees 580 odd crores for Q3 FY24, contributing 16% of overall top line. The growth in other product business is mainly on account of EV products, controllers, sensors, and blow and injection molding business. Our controller business has experienced remarkable growth in recent years, nearly doubling its revenue in Q3 FY24 compared to the same period last year. This momentum is expected to continue with new orders for wireless chargers from a four-wheeler OEM secured in the current quarter. Moving to slide number 14 and 15 to our aftermarket and industrial revenue slide. In terms of our revenue pie for the quarter ended December 23, OE business accounted for 92% and aftermarket accounted for 8%. Our aftermarket division revenues stood at 273 crores during the quarter. Our international sales currently represent approximately 14% of total revenues, demonstrating steady growth in this segment. While the international market holds strategic importance for our future expansions, it is worth noting that our domestic business has been experiencing more pronounced growth. Moving to EV, you can refer to slide 15 and 16. Revenues from EV two-wheeler OEMs increased to rupees 164 crore in Q3 as against 143 crore in last quarter. We witnessed growth in EV specific as well as traditional product sales to two-wheeler EV OEM. The revenues from EV two-wheeler OEM is expected to continue to increase with SOP of various orders. During the quarter, we have received new orders having annual peak revenue of around 250 crore from EV OEMs Out of which 200 crore pertains to EV-specific products comprising of off-board chargers, motors, and motor controllers. Notable orders include off-board charger from three-wheeler OEMs, EV motors order from two more new-age EV OEMs. Uno Minda, in JV with Bula Motors, have high-quality electric drive technology. Capitalizing on the same, we have now further diversified our customer orders. We are confident that with our cutting-edge technology and years of expertise, we will continue to win more orders and help in establishing our market leadership. Moving to cash flow and debt levels, our net debt as of December 31 was at rupees 1296 crores compared to 1078 crores as on March 31, 23. The net debt has increased primarily on account of land bank at Pune and Hosur of around 140 crores, while sustaining and growth capex has been financed largely from business cash flows. Our net debt to equity as at 31st December stands healthy at 0.26. We have achieved ROCE of 18.9%, which is annualizing profits of 9-month FY24. Kindly note that capital employed considered for calculation includes the capex for land bank as well as CWIP, which is currently not generating returns. ROC would be around 19.3% if we were to exclude only the strategic land bank. Our annualized return on equity for 9 months of FY24 stood at 17.9%. The board has also approved and declared interim dividend of rupees 0.65 per share, which is 32.5% of face value, reflecting commitment from the company to return value to shareholders on a consistent basis. The interim dividend for FY24 is 30% higher as compared to last year's interim dividend. Moving to slide 18 on strategic business update. We would like to inform you that merger of Minda iConnect with Uno Minda Limited has been completed. Last quarter, we had informed that merger of Minda TG Rubber Private Limited with TG Minda was also completed. With respect to merger of COSE entities with Uno Minda, we had received NOC from exchanges and had filed the scheme with NCLT. NCLT in its hearing has reserved the order for convening the meeting of shareholder of Uno Minda Limited and that of unsecured creditors. We expect that it will take around 4 to 5 months for merger process to get completed. In terms of our land bank acquisition strategy, Uno Minda has been proactively securing land parcels in all major auto hubs to be ready to meet the growing demand from OEMs. Uno Minda had acquired 86 acres of land at Khed City Industrial Park, Pune, and is in process of acquiring 37 acres land parcel in Krishnagiri district, Tamil Nadu. We are also at very advanced stage for getting allotment of land of around 95 acres in North upcoming auto hub. This strategy offers multiple advantages, couple of them being Uno Minda can avoid delays associated with land acquisition by having readily available land, enabling quicker response to growth opportunities. Second, larger plots allow building bigger plants and consolidating existing ones, leading to improved operational management and economies of scale. Moving to some recognitions and accolades, you can refer to slide 20. At Uno Minda, we strive to be leaders in 3 key areas: pioneering technology, fostering entrepreneurship, and fulfilling our social responsibility. Our dedication to these values has recently been recognized with prestigious awards. For second year in a row, the CII has recognized Uno Minda as top 50 innovative company, acknowledging our groundbreaking work in automotive technologies. This achievement reinforces our commitment to pushing boundaries and developing solutions that drive the future of the industry. Furthermore, Mr. Nirmal Minda, our chairman and managing director, has been awarded by the esteemed Hurun India Self-Made Entrepreneur of the Year 2023. This award recognizes his inspiring leadership and vision, which have guided Uno Minda to its current success. Uno Minda has also been recognized Great Place to Work by Great Place to Work Institute India for the 3rd consecutive year, appreciating of our people-centric approach. Beyond innovation and business leadership, we prioritize giving back to society. Dr. Suman Minda, chairperson of our CSR wing, has been honored with the Golden Peacock Award for Social Leadership by Institute of Directors, India. This prestigious recognition reflects her impactful work in the social welfare and community development, showcased at the 18th International Conference on Corporate Social Responsibility. Under her leadership, we empower communities and create sustainable solutions for a brighter future. These awards serve as a testament to UNO Minda's commitment to comprehensive excellence. We remain dedicated to driving innovation, nurturing entrepreneurship, and making a positive impact on the world around us. Moving forward, we witnessed the best ever monthly sales for PV in January 24, with two-wheeler also posting decent growth. The outlook continues to be promising with supporting industry volume guidance, ramp up of multiple new expansions, namely EV plants, two-wheeler alloy wheel expansion, four-wheeler switch plant in Farrukhnagar and Chennai, EV motor plant, etc. With our existing diversified product portfolio and new product and technologies, we are confident of sustained outperformance. With this, I would like to now open the floor for the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashin Modi from Equirus Securities. Please go ahead.
Hi, thank you for that opportunity. So my first question is regarding the lighting business. So we are seeing good ramp up in terms of orders over there. So what kind of peak revenue do we see in our lighting business by FY26 as per our current order book?
Okay. Any other question you have, Ashin?
Yeah. So the second question was regarding the EV specific components. So we now have around 1,900 odd crores of order book. So could you please provide more color on that? Which are the segments and by when do we see peak revenue from this EV specific orders?
Okay. That's it?
Yeah. Okay. Yeah. My last question was regarding the alloy wheel business. So, could you please provide the number of the revenue from alloy wheels, and if you could further break it down into two-wheeler and four-wheeler alloy wheels? Yeah, that's it from my side. Thank you.
Thanks, Ashin. So in terms of lighting, as we have shared, we continuously seeing a very, very good traction in the lighting business. So our endeavor is how do we first move our lighting business share of business from 14%, 15% range to 19-20% in the near future, maybe next 4 to 5 years. You will appreciate we have commissioned earlier last year the lighting plant in Gujarat. We are currently constructing a new lighting plant in Pune, and that also the business capex is spread out over next 4 to 5 years in order to meet our revenue growth and link with the capex investment. We don't want to upfront all the capex, so the investment is spread out over 4 to 5 years of almost like 500 crores. So in terms of peak revenues, it's as of now it's a blue sky. We are already this year almost like 1,000 crores run rate, and we expect these revenues to double in next few years as the immediate target. In terms of EV specific, by when we see peak revenue, as of now, as you also know, that the EV business is something which is consistently growing, and we are adding new business every quarter. So I'm not sure when do we see peak revenues, because for next 10 years, the expectation or the projection from various agencies is the business will continue to grow, the penetration will continue to grow, and two-wheelers are expected to be almost like 40% penetration in next 8 to 10 years. So it's very, very difficult at this stage to say when will be the peak revenue, because today whatever business we have secured, and you see in the slide, while that peak revenue is expected to achieve in 26-27, we will continue to see the new highs being made as we move forward. So I think that's the answer on the peak revenue. In terms of casting business, you asked for the revenues for two-wheeler and four-wheeler. So our two-wheeler revenues is somewhere around 170 crore for the quarter, and four-wheeler was almost 317 crores.
That's game.
Yeah. That's what we have.
Yeah, thanks.
65, yeah.
Yeah.
Thank you. Our next question is from the line of Ajox Frederick from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. So my question is around on castings. You mentioned that the QOQ slowness was due to RM and volume. Can you help me with the split, sir? How much of this slowness was due to RM being lower, QOQ, and the volume basically for the quarter?
Yeah, Jox. So in terms of volume, it is largely dropped at the four-wheeler volumes because two-wheeler has, because of the additional capacity, has done relatively well. So two-wheeler, there is not much of a drop in terms of volume. It's actually better. Four-wheeler, there is a significant drop because of volumes. In terms of the split, maybe you can take it offline if you don't mind, Jox.
Sure, sir. Sure. Okay. And sir, how do you see this business going forward, let's say 2-3 years some way? Because we are, of course, building capacity in this space. So what is your vision?
Yeah. So this business, we are very, very bullish, Ajox. In fact, we have been consistently investing in specifically four-wheeler business almost every year. The board has just approved setting up of another plant in North by investing almost 540 odd crores. This business, we are very optimistic in a way if you have to see the alloy wheel penetration. So when we entered this business 6-7 years back, the alloy wheel penetration was 13-14%, which when I say penetration, which is application, alloy wheel versus steel wheel. Today it is almost 40-45%. And globally it is somewhere around 90-95%. So India has to catch up this growth of application of alloy wheel versus steel wheel, which we expect to continue over next 8 to 10 years. It is not something which can happen in a very, very short frame of 1 or 2 years, because you also need that capacity to deliver those volumes. So that's number one. And number two, over the same period, we also expect that the volumes to double, right? On top of it, what is happening is the size of the wheel has been increasing from like 14-inch wheel, 15-inch wheel to almost like 18, 19, 20-inch wheel. So that also increases the kit value per car, because as you move from a sedan to an SUV, right? So over next few years, we'll consistently see this business to grow, and we are pretty optimistic you will see almost 4x kind of a growth over next 8-10 years.
All right, sir. That's very promising. Thank you, and all the best.
Thank you, Ajox.
Thank you. Our next question is from the line of Mumuksh Mandlesha from Anand Rathi. Please go ahead.
Thank you so much for the opportunity, and congratulations on the continuing EV order win, sir. Sir, on a year-to-date basis, EBITDA margins are slightly lower despite the robust revenue growth we have seen. Can you indicate which segments on year-to-date basis have seen a lower margins and reasons for the low margins, sir?
So, Mumuksh, while you appreciate that we have stopped giving the segment-wise margins, I think 3-4 years back, based on some feedback from various stakeholders. But I can tell you that the margins are not significantly off. If you see the beginning of the year itself, we have guided our margin range of around 10% for next year or a couple of years at least, because we know that while the top line is improving significantly, there is also a significant growth which is coming from the new businesses and the new plants which are getting commissioned. So you'll appreciate what happens is that all these new businesses or new plants initially for 2 to 3 years, they don't deliver the kind of return you expect. In fact, in first year they are actually negative, first or second year if you see from profitability perspective. And even when we approve investment, we approve on the third full year of production to achieve our normal profitability. So that has been a little bit of a drain. Plus on top of it, we have been investing heavily in terms of our R&D and other expenditures. So that also is fully charged off to revenue. So we are not capitalizing any sort of R&D engineering spend. So overall, I think this is in line with the expectations. Yes, year on year maybe marginally less, but if you see on a full year basis, maybe we'll try and catch up something in the Q4.
Got it, sir. Sir, in the seating segment, year-to-date growth is about just 6%, which is broadly in line with the industry. Any reason for the where we are not seeing a much outperformance this year?
So seating business, we have actually got a lot of new businesses recently in last 6 to 9 months. But you will appreciate that all the new business what you secure has is linked to the new model launched by the customer. So a lot of this business what we have secured, you will see that coming in the next few quarters, not immediate near future as you go and link with your customers' volumes, right? So that's number one. Number two, we have tried to maintain our SOB and we have been focusing a lot on exports. We continue to do very well on exports. Last year we did a record export. So this year, obviously, because you know the global situation, there will be a little bit of impact because of export, which is we believe is temporary. Our exports primarily to the North American market this year have been bit lower compared to last year. This is what is little bit pulling down. But overall, we are optimistic that will also catch up from the next year onward. And also, we added a lot of new customers, as I said, be it from EV perspective or be it from the existing two-wheeler player perspective, or maybe adding export customer for the suspended seats which were not there earlier. So a lot of action is happening. And just to recollect, if you remember when we acquired the company, the revenue was 630 crores in 2021, but pre-COVID it was 750 crore, and our target was to double the revenue in 5 years. Where we stand today, we are pretty confident that the target we can achieve in actually 4 years, a year before the target. So we are expecting that 1,500 crore of revenue to deliver even ahead of timeline. So yes, this quarter-on-quarter might be a temporary blip, but we are pretty confident that we will be able to do better than what we have added.
Okay, sir. Lastly, can you talk about the current size of the wireless charger revenues, and also based on the new order wins, what is the revenue expected from this product line over next 2 years?
Mumuksh, I have request modeling questions if we can take it separately, please.
Okay, sure. Thank you, sir. That's all from my side.
Thank you.
Thank you. Before we take the next question, a reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Siddhartha Bera from Nomura. Please go ahead.
Yeah, sir. Thanks for the opportunity. Sir, first question again is on the lights. I mean, in the past few quarters, if I remember, we have continued to indicate that multiple new order wins we have received from various customers. That probably has been slightly missing in the last this quarter or probably the last quarter. So just wanted to understand, I mean, should we expect some moderation in the growth trends, because this quarter also the growth has been quite healthy. Now, if those orders only mature and no new orders kick in the next couple of quarters, should we expect some of these growth trends to normalize?
So that this growth trend will not normalize, it will continue to grow. In fact, just to put things in perspective, Q3 of FY24, our lighting revenues was 178 crores, and four-wheeler you are talking about, right? And this Q3, we have done 340 crores. It is 2x of last year. So I'm not sure from where you are getting this perception of moderate growth.
No, I'm talking about the next year, because I understand this year, this quarter growth has been quite strong. But if the industry, say for example, four-wheeler industry grows at 5-6% in terms of volumes, can we do this 30% growth even next year, or I mean, it will need more order wins to probably get that growth?
Siddharji, with your blessings, we would endeavor to work to deliver similar growth, but you know that we normally don't comment on the revenue growth, because it is large part also is linked to the OEM growth, right? So if industry grows, definitely will grow, but be rest assured, whatever we have guided in terms of our outperformance, we are working to deliver better than what we have assured.
Got it, sir. Second question is on the seating side. We have done a couple of TLAs in the past, and also a couple of orders on the recliners. And also, can you just throw some color if we have won any orders there, or what is the progress, so that which can lead to a better growth momentum in the business?
Yeah. So seating, as I said, we have added a two-wheeler customer, existing two-wheeler OEM, among the larger ones in the country, which was not as part of the seating business. That supplies we are expecting to start by end of this quarter, which is not yet in the revenues. We have also been getting a lot of traction in terms of suspended seats. You know, the kit value suspended seats is almost like 18,000-20,000 rupees. we have secured an export order on the seats, and we are working aggressively on that front, and we are hopeful that in this quarter also we'll be able to secure ones, which we'll be able to announce in the next quarter. There's a lot of traction happening from the seating and also in terms of actually higher kit value via these suspended seats. So there is a lot of steam ahead, be rest assured.
Got it, sir. So lastly, if you can share the sensor and controller revenues for the quarter.
Sensor and control, I think it's your favorite question. So sensor and controller put together, we have done actually almost 194 crore of revenue in last quarter.
Got it, sir. Thanks a lot, sir. I'll come back.
Thank you, sir.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Ladies and gentlemen, to ask a question, please press star and 1. Our next question is from the line of Raghunandan NL from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity, and congratulations for another quarter of 20% growth. Sir, firstly, you indicated market share gains in various segments, and on lighting, thanks for sharing details. I remember it was 13% share in FY21, currently 14-15%, and target is 19-20%. Any other segments where you can call out where company has seen market share gains, and what kind of targets are you pursuing?
Yeah, so in lighting, we are working in terms of gaining market share, not only four-wheeler but also two-wheeler. Even though we are already at 24-25%, we are working to see how do we get closer to our target of getting 28-30% share in the business. Switching, we are already 60+% market share in two-wheeler and 50+ in four-wheeler. So there we are focusing a lot on exports. So we will not be able to convert that into market share. As you know, we have added a major customer, export customer, North American in two-wheeler switch segment, which has been doing really good in terms of new business, though volumes have been impacted because of the global headwinds this year. But overall, we are getting more and more inquiries from the export segment. So as I said, you might not see the SOB gain domestically, but exports will definitely add. Same goes for the seating. So we are adding more customers there and also adding export customers. So you'll see the gains there also. EV segment continues to do very well. So there you will see a lot of uptick as we have been guiding. Acoustics, as you know, we are already 60+% kind of market share, and there we are working to hold on to our market share and see how we can sort of inch up to the extent possible. Casting is another segment, as you know, that we have been working very aggressively. Both two-wheeler and four-wheeler alloy wheels have been doing phenomenally good. Four-wheeler, we continue to gain our market share, which is more than 45% now. And two-wheeler, as you know, we just started a year and a half back, and we just commissioned our capacity for two-wheeler alloy wheels this year. So I'm sure this is not something which we are going to stop at, because still there are a lot of imports into the country. We are trying to see what opportunity we can capture. So there are a lot of businesses where we are working to consistently and continuously see how we gain market share. On top of it, we are also working to improve our kit value, because it is not only market share, the kit value also makes a big difference. So all this put together, I think we are very, very optimistic and aggressively working on growth for the next decade.
Thank you, sir, for the detailed answer. One clarification, within the switches space, how big would be exports, sir? I mean, a couple of years ago, I remember it was below 10% of the switch revenue. How would it have trended now?
Yeah, so in terms of two-wheeler switching, it is almost, I would say, close to 15% of the revenue, which is export. Final details, maybe Ankur can share offline, but that is at a very high level. PV, we have a JV for PV switching, so there is very small export in PV switching.
Got it, sir. Sir, on the EV side, 3,300 crore is a big number on the order. On an annual revenue basis, would you be confident of crossing 1,000 crore for FY25? And within this revenue, how would you see the breakup between the EV specific parts and engine agnostic parts?
So definitely, Raghu, we are actually working to see how do we cross the number you have said, but as you know, a lot also depends on the industry penetration. If you see from our readiness perspective, I think we are all geared up to deliver the kind of numbers we just spoke about, right? And in fact, we are gearing up ourselves to do even better than that in FY25. But it all depends on the industry penetration because we are still close to 4% penetration in the two-wheeler segment. So I think that's only, I would say, the moving post. Otherwise, we are all geared up. In terms of the split of EV specific and engine agnostic components, we do expect it to broadly in the ratio of what we have shared in terms of our order book, which is 60/40 in terms of EV specific versus engine agnostic components. Because the key reason being the EV specific components also the kit value is much more than the engine agnostic components. So that's why the proportion also we expect it to be more than the engine agnostic components.
Got it, sir. And sir, you also alluded to PLI incentives. Any progress there? By when should we start receiving incentives? And the amount allocated in the budget seems small, given the kind of EV sales which is happening. So do you expect pro rata kind of allocation?
So, Raghu, to be honest, as you know that the PLI incentive for auto has been for advanced technologies, the AAT as we call it. So the products which qualifies into of Minda products are sensors, some controllers, some telematics, and the EV specific components. So there also we are working to see how do we make sure that we meet that 50% EV target because electronics is still there a large part which is imports in terms of the semiconductor and chips. So there, I think they're still in the works. As of now, I won't bank on significant PLI income in the current year or the next year.
Got it, sir. And sir, on the tax rate, the rate was on the higher side for the quarter, and notes to accounts also indicated that it includes taxes for earlier periods. On a sustainable basis, would 24-25% be a right number going forward?
Yes, you are right, Raghu. That's what the number 25% we are targeting. But what happens? There are some businesses, specifically a Clarton, on etc., which are into losses, and we don't recognize the DTA on that losses. That's why the effective rate actually goes up. So otherwise, on a normal steady state basis, yes, that's the kind of number we are working on.
Got it, sir. Thank you very much, sir. Very useful.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask a question. To ask a question, you may press star and 1. Our next question is from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, sir. Good evening, and thank you for the opportunity. First question is when I look at the potential kit value on the EV business, I realize that we kind of reduced it, as in the product under development we have removed it now, 26,000 rupees. So is that the battery packs which we no longer want to target?
You are exactly on the right, Mukesh.
Okay. So, as in we're not targeting this because we have done our study and we realize that we don't want to kind of go into that area because of competition, profitability, or is it just a capability and you don't want to have another JV doing that or something like that?
So we do have capability and competency, Mukesh. So our JV partner has the battery pack which they are making in Germany. But we have been discussing about reevaluating this because of very low value add. Why we have removed from the chart is because we didn't want to have any expectations built in that this is a significant value, because even if it happens, the profitability is going to be very, very less. So though we have removed from the presentation, but we continue to look at in case there is a possibility of getting a customer with some decent margins. So we are working on it, and we thought it's better to sort of communicate once we see the business visibility rather than keeping that expectations on the kit value.
Right. Got that. And secondly, on the CapEx update as well. And, there are two new facilities that we have added on airbags and the seatbelt slash smart systems. Could you kind of give some sense on this? Because I think the airbag business we are saying will start in F25 itself.
Yeah. So I think, so what was happening... Sorry, Mukesh, your voice went off in between. I thought you were completed.
No, sorry. What I was asking is, in airbags, as an industry, where do we stand now in terms of market shares and what are our targets?
Okay. So airbags, in terms of market share, we are roughly around 18-20%. And we are working to see how do we go closer to 24-25%, but that will take some time. In terms of this CapEx, you know that gradually businesses have been, OEMs have been moving towards the increasing number of airbags. Even though the regulation now is not there, it is now moved to the star rating system versus the number of airbags being mandated and left to the consumer to decide based on the star rating, whatever he prefers. So the maximum airbags gets the 5-star rating, things like that. But because of that, I think a lot of OEMs have started work on increasing the airbag. In fact, nowadays you are seeing minimum 4 airbags are there anyway. So that has necessitated this plant expansion, which was started in the last quarter, and we are expecting it to commission in next 8 to 10 months. That's in terms of airbags. Did you ask anything on the seat belts and smart systems?
Yeah, I mean, that also seems to be a new area that we are, and the smart systems, if you could explain, sir, what exactly that?
Yeah, so, we have a JV with Toka in South, which is into seat belts, gear shifters, locks, keys, etc. So there we are putting a new plant in Nimrana to cater to the north market. As of now, that business was limited to south and being a plant in Bangalore. So that's about this business.
Got it. And just the last thing, I know there have been a couple of questions on seating, but I was just wondering, we had this tie-up or a JV with Tachi S for four-wheeler seating systems, reclining systems, etc. Any kind of a development there on four-wheeler seats? You have commented about orders on two-wheeler seats, but any development on four-wheeler side?
Yeah. So, Mukesh, you know that we have been consistently, I think, saying that four-wheeler seat is something which will take some time to sort of build, because we know that the industry where we are in terms of PV seating, there are a lot of what we call OEMs who also have equity in their four-wheeler seat providers. So it's little difficult to enter into that. So we also said we are having the JV. The JV partner has 65 cars across the globe and got best of the PV customers and PV seating technologies. But in India, we wanted to go a little slow and step by step. Mm-hmm. So we just inaugurated the plant which will manufacture the mechanism for seat recliners. So it is only mechanism, a small part of the recliner. In phase 2, we will work to see how do we make recliners, then move to frames and then move to seats. So it's going to be a painful journey, something which will take time, and that's how we are also trying to see that we put investment once we have visibility of a business. There is no point of putting investment and then scouting for business. So I think that's the approach we have adopted for PV seating. We are already in discussion with some of our customers for PV seating. We have given them our value propositions. So it is more of at a discussion and engineering technical evaluation stage.
Got it. Great, sir. Thank you so much. I'll get back in touch.
Thank you.
Thank you. Our next question is from the line of Rishi Vora from Kotak Securities. Please go ahead.
Yeah. Hi, sir. Thank you for giving me the opportunity. 3 questions. First, on the alloy wheel business, can you roughly tell us what is the split between, for the industry, what is the split between GDC and LPDC wheels, and how do you think this mix will shift over the coming years? Is one technology better than another, one type of wheel better than another, or you think that whatever the current mix is, it will sustain? Secondly, on the lighting segment, what would be the current LED penetration both in PVs and two-wheelers, and how do you expect it to, let's say, inch up over the coming years? And lastly, on the EV business, on the two-wheeler, three-wheeler side, we have, we have a good EV specific portfolio as well. So when do we start looking at the passenger vehicles? Like, are we looking at any specific penetration numbers for the industry to reach before we, start looking aggressively into, let's say developing products for the EV passenger vehicle segment as well? Thank you.
Thanks, Rishi. I think very, very important point. So, your first question was on alloy wheel, any split on GDC, LPDC. So, and also, is there any technology difference, etc., and do we see any shift? So, just to give some background. So, if you see the technology-wise, in one technology, the rim is stronger, another technology, the center part is stronger. So in terms of performance, there is zero impact. But as in terms of ideology, different OEMs have different ideologies. So if you see the customers, primarily the Japanese customers would have been using GDC technologies. And if you see the Korean and the European customers have primarily been using LPDC technologies. So once a customer uses GDC, you rarely would find him moving to LPDC or vice versa. So now, in terms of ratio, it all depends on the way the industry grows. So if a customer or a OE who is using GDC grows more, then obviously GDC will grow. Or if somebody is LPDC more, the LPDC will grow. So I think that was the reason why we also gradually started wanting to get into LPDC. And while we still are primarily the GDC wheel manufacturers, LPDC, the perspective, we have put a 25 KT per month line in Gujarat, which is running very fine. But in terms of new business, we have been obviously getting some inquiries for LPDC, but they have not been remunerative enough to justify a new capex. So from that perspective, I think we are all geared up to serve both the customers. And it's very difficult to comment what will grow more, what will not grow more. Moving to the lighting.
Sorry? Just a follow-up, sir, but there is no shift that is happening within the OEM, right? Whoever is following the GDC, they want the GDC technology itself, right?
That's what we have been experiencing currently. We can't say about future, but that's what currently it is.
Understood. Thank you.
In terms of lighting, LED penetration, so LED penetration in two-wheeler is significantly higher than four-wheeler because of sheer kit value. As you know, the kit value is more than 3 to 4x of halogen versus LED lamp. So two-wheeler, the penetration is significantly higher, almost 25-26% penetration versus a four-wheeler. So four-wheeler, what is happening is you would have seen that mostly the vehicles come up with a DRL, which is a daytime running lamp, which is LED, but the lamp itself is not a LED, it's a halogen lamp. So while the DRL in terms of LED penetration is there across, but in terms of LED lamps, it's still catching up. And mostly, if you see, it is catching up in the tail lamps. So tail lamps actually are becoming more and more complex. You would have seen the tail lamp of almost 4.5 feet. It's complete LED lamp. And LED tail lamp are actually getting more complex than a headlamp. So penetration of headlamp and tail lamp LEDs, I don't have readily handy available. Maybe we can work to see if we can give you offline, but that's where we are. In terms of EV business, PV, are we looking at any industry penetration before we start? It's not like that. So while partly you are right that the industry penetration is very less, is roughly 70,000-80,000 cars a year in terms of EV, and that also components are largely imported. So we have been working on our four-wheeler EV strategy, and hopefully in next 1 or 2 quarters we will be able to come out in terms of our EV strategy for PV specifically, because you are right, you need certain volumes to sort of start investing. So we are working to see how we can balance in terms of capex and the revenue, and before that, what kind of products we will have in terms of EV. We have been working a lot of them. You would have seen us in the expo also, be it the Auto Expo or the Mobility Expo. We have displayed a lot of products from the EV PV perspective. But in terms of coming up with a comprehensive slide of the product portfolio, like we have for two-wheeler and three-wheeler on a presentation, maybe in a couple of quarters we'll come back with the PV side as well.
Sure, sir. I'm looking forward for it. Thank you and all the best.
Thank you. Thank you, Rishi.
Thank you. The next question is from the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yes, good evening, and thanks for the opportunity. So I just wanted to check on the EBITDA margins front. So we have been clocking this 11% kind of range for quite some time. So at the company level, is there any endeavor to improve it by, let's say, 50 basis points or 100 basis points each year going forward? Or how do we should look at it?
So absolutely, Shashank, I think that has been our endeavor. So large part of our business growth, even though we have been delivering 20-25% kind of a growth, we have not been able to get advantage of operating leverage because of the reasons we just spoke about a little while back in terms of new plants, new capacities, or some new business like electronics, which is at a little lesser margin than the average margin, but it compensates in terms of ROCE. So our endeavor is how do we deliver return on capital of 20% and then see that whatever margins are required, we deliver in that line. Yes, in terms of near future, our endeavor is to grow the margin from 11% range to 11.50 and then 12 as we move along. But immediately in the next year, we hopefully should be around and consolidating at this range before we move forward.
Right. And so does the increasing share of business from lighting and light metal technologies help you in the margin front, given that you're doing a lot of value addition there?
It's actually one is productive, one is counterproductive. So it all depends on asset turn. So you know that the castings, the asset turn is very less, but the margins are better, which is reverse for lighting. So actually one compensates for other. So excuse me. So I think that's where we are.
Right. So secondly, for next fiscal year, what is the kind of volume growth assumptions or indications are we getting from the OEM? So some of the PV guys have been mentioning about less than 5% kind of industry volume growth. CV's pace is talking about decline. So your assessment of this demand cycle, and especially for the two-wheeler segment?
So Shashank, I think we normally don't comment on the industry numbers. I think our customers are best placed to respond to that. We don't want to second guess them.
Okay, but sir, our endeavor is to outperform them, right? By what margins or any particular ratios are you thinking about?
So our communication has been very clear, Shashank, that over a long term, I'm not saying 1 quarter, 2 quarter, over 8 to 10 years, I think we have been working to see how do we consistently deliver at least 1.5x of the industry growth. Yes, in past we have delivered much more than 1.5x, but when you talk of much longer term, our endeavor is to deliver consistently at least 1.5x, and in short term, maybe we'll do better than that.
Sure, sir. Thank you so much and wish you all the best.
Thanks, Shashank.
Thank you. Ladies and gentlemen, the last question for today is from the line of Nikhil Kale from Invesco. Please go ahead.
Yeah, thank you. So I had just one question, which is regarding the exports part, specifically in alloy wheels. So just wanted to understand or get your views on, do you see a big opportunity on alloy wheel side? Because I think a couple of your peers are looking at it in a big way. And again, maybe just the technology aspect of it is that given that you would be majority GDC, does that kind of limit the export opportunity for you?
So Nikhil, honestly, we have been actually working very, very aggressively in past to see how do we serve the export market. In fact, in past we had business also which we could not deliver. It's a good problem to have, but the problem is that the domestic market has been growing at a pace much faster than what we were increasing capacities. In fact, the last capacity which we were to expand at Bawal, which we could not do, that has become a little bit counterproductive. So we are working to see that we have a dedicated export sort of a capacity available in the next capacity expansion, whatever we do, because in the export market, once you get into it is not something you can do up and down. You have to be consistent in terms of the supplies. So since our hands were all full in terms of domestic demand, and consistently our customers have been increasing their indents, we have not been able to sort of support our export market. So, but that remains a big area of focus, and hopefully in our next leg of expansion, we will come up with some capacity which will be dedicated to serve the export and aftermarket segment.
Got it. Thank you. That was all for me.
Thanks, Nikhil.
Thank you. Ladies and gentlemen, that brings us to the end of the question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you. So I would like to thank everyone for joining on the call. I hope we have been able to respond to all your queries adequately. For any further information, we request you to please get in touch with us. Stay safe, stay healthy, and thank you once again for joining.
Thank you. On behalf of Uno Minda Industries, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.